tuning into Quiet Light's webinar series. We have an awesome webinar for you today, all about the future of the aggregator market. So we will give everyone just a minute or two to tune in, grab a coffee or a water, snack, maybe lunch, depending on your time zone and how your day's going. And we'll get started in just a few minutes. If you have any questions already prepped and ready to go, you can throw them into the Q&A chat box that's just at the bottom of your Zoom. We'll be answering those live throughout the next hour. It could be now, it could be in 20 minutes. We've got you either way. Okay. All right, I think we'll get started. So welcome everyone. You are tuning into Quiet Light's webinar for October. We are talking about the future of the aggregator market. And we have two awesome Quiet Light advisors to speak with today, Chris Duty and Brad Wayland. So before I get to introduce them, just a quick rundown of what you can expect today. We're going to be answering any and all questions from you live. So feel free to send those into the Q&A chat box right at the bottom of your Zoom screen at any point. That can be right now, it can be in 5 minutes. We'll get to them. And then we'll be talking about a ton of different things. Just to give you a quick sneak peek, we'll be talking about what aggregators looked like a few years ago compared to what they look like today. We'll be talking about the buyer pool in general and where the aggregator fits into that, if that's your only option. We'll be talking about multiples, everyone's favorite topic, and so forth. So I won't give away too much, but that's a little sneak peek of what we'll be doing. So a quick background on Quiet Light for anyone tuning in who might be new to us, welcome. Quiet Light is entrepreneur-led, meaning all of our advisors or brokers are entrepreneurs themselves. They have all bought, built, and or sold, in many cases, all three of those things, online businesses for themselves. So we're very lucky to have them. They're super qualified to be able to speak to their own hands-on experience, their own real life experience. Very lucky to have such an awesome team. A lot of what we do is education-based. So webinars just like this. We have a podcast that comes out every week. We have tons of blog posts on our website, quietlight.com. We have a YouTube channel with tons of content. So if you are an entrepreneur looking to buy, build, or sell your online business, you have come to the right place. Okay, enough of the nuts and bolts. Let's get to our amazing guests for today. So first, I'd like to introduce Chris Duty. Chris has been an entrepreneur since he was 15, showing all of us up. I was not an entrepreneur when I was 15 years old. And he started his first internet business reselling electronics on eBay. Since then, he has helped start multiple online businesses, including an SEO agency, an online real estate brokerage, and a flash sale website. Eventually, he entered the VC-backed high-growth startup world, where he honed his skills in mobile product management at Retail Me Not. He had leadership roles at VC-backed startups in London and in China. And he was also a founding member of the first Amazon Aggregator 101 Commerce. So very fitting for today's conversation. Super happy to have him on board. And a fun fact about Chris, he is currently missing a front tooth. So we're very excited that he still made it here today. Thank you, Chris, and welcome.
Yeah, thanks for having me. Sorry if you can't understand me that well. I have kind of a mouthpiece in right now, but I'll do my best.
Perfect. Thank you for still coming. We appreciate it. And I'd also like to introduce our other guest, Brad Wayland. He is also an advisor at Quiet Light and an entrepreneur. He got his start in the online space in 2003 when he bootstrapped an e-commerce business to millions in sales and 130 employees. But he didn't stop there. He acquired 26 content businesses in a roll-up and had a private equity exit in 2015. He has led 50, that is 50 deals to successful exits for Quiet Light clients. So tons of experience we can lean in on today. And so needless to say, basically with 20 years in the industry of buying, building, and selling, we're very excited to have Brad as well. And when Brad is not doing all this entrepreneur stuff, he is married with 5 kids, and all of them are boys, that's a lot of boys, Brad. Thank you for joining us.
It is a lot of boys. Thank you for having me.
Yeah, absolutely.
You don't get to control the gender. So it's, I didn't know that was that was what was coming, but apparently my wife and I produce boys. So.
Yeah, from a family of all girls, I can't imagine. Good for you guys. Well, just to get us started, I know I just gave a good bio for each of you, but Chris, I'll start with you and then we'll have Brad go. Just what got you into entrepreneurship in the first place? Like, how did you enter this world of online business?
Yeah, so I kind of grew up in a household to where the idea of entrepreneurship was around me. My dad was a venture capitalist, kind of in the early days. It looked very different than what venture capital looks like now. Back when I was growing up, there was just a handful of venture capital firms. They were all colluding with each other on deals and that sort of stuff. But with that said, I got to see kind of what it looked like being around entrepreneurs that my dad was investing in through the fund that he was a part of. So I kind of saw things, different in the sense that, there was another way to, make money in this world, going to work for yourself and starting a business versus kind of going the traditional route. And so I kind of did that a little bit in my earlier days, both kind of like as I was entering high school and then after college as well. And then ultimately kind of found that, I really wanted to go learn from some of the leaders that were growing some of these big e-commerce startups. And so that's ultimately how I got into the high growth VC backed startup world, which I really, really enjoyed and learned a whole lot there. I then kind of, after doing that for 10 or 15 years, randomly stumbled into the Amazon world via a friend who had started a business on Kickstarter. And he was then going on Amazon and was doing really, really well there. And we were friends and he asked for some help. And so I kind of got into the Amazon ecosystem then and helped him grow that business. And he ultimately exited that business early in 2015. So it's kind of an early exit kind of in that world. That led me through kind of my VC contacts to what became 101 Commerce, which was late 2017, early 2018, where I met Richard Dalchandra, RJ, and Keith, and who were the two kind of founding members of that. And they asked me to join what became 101 Commerce. And I think, to my knowledge, that was the first company that at least called itself an aggregator. It was funded about 4 or 5 months before Thrasio. So that was kind of my full circle to ultimately getting to the aggregator world.
Nice. And Brad, for you, like, what brought you into the entrepreneurship online business world?
Yeah, in my household, my father was a corporate guy, so I kind of spent a lot of my childhood and even getting a finance degree and things like that, thinking I would go corporate. But I had always done kind of entrepreneurial things to kind of pay the bills. I painted my way through college. And, I just was always looking for opportunities to find a way to make a buck as a child. And sometimes things that would get me in trouble. Like at a summer camp one year, I bought up all the candy during the day and then was selling it for 3 times the amount at night in my room. And my sister was at the camp with me and they came and they were like, hey, you can't buy the Reese's and sell it for $3, at night whenever no one can get to the snack bar anymore. And I remember my sister being like totally mortified by it. Like, Brad, what are you doing? You're taking advantage of people. And I thought, well, everyone's hungry when they get back to the cabin. It's a great way to make money, So I always kind of gravitated towards that, but always thought, because of my dad, I looked up to him and the things that he had done in business. And so I kind of wanted to follow in his footsteps, and I got a finance degree and I got a job doing financial analysis and some accounting things at Camping World. And within like 3 months, I was like, I'm going to get fired from this job. Like, I will never make it in this environment. I've been running my own businesses since I was, 16 years old, and I'm not going to be able to survive. They'll never think I'm any good. I really had no confidence. And so left there and partnered up with 2 friends that were doing custom t-shirts. That's everybody's story, is custom t-shirts at some point, it seems like. But and they were selling to groups. And so they started tinkering with going online with it. So I jumped in and started working on it, took over, doing some paid advertising. And we got some easy wins before there were things like analytics and a lot of the tools that people use today to measure results, and quickly got kind of enamored with ranking. And so I spent several years trying to figure out how to make this business rank for keywords. And so I really would love to say that I figured it out in 3 months, but it took me more like 3 years. But when we did figure it out, we figured it out in a pretty big way. So we had launched a t-shirt designer for ordering shirts for groups in 2007 that there was no social media in 2007 really to speak of. And so Gizmodo covered it on the front page, saying we had built a Photoshop-like environment. And we just got so much traffic that the site crashed. And then links just started flowing in after that. We had built the tech in Flash. And so Adobe started linking to us. And all this SEO work that I had done started paying off, and we started ranking for thousands of phrases. And so we were drinking from a fire hose, trying to get production out the door for over 5 years after that, just trying to kind of keep up with it. But that turned into like a factory. Still exists today, 110,000 square foot facility, produces custom t-shirts. I sold my shares in that business in 2019. But in 2010, I really was looking for like, hey, I want to do more of a pure web play. I don't want to manage these people. I don't want to have to deal with these deadlines and in situations. A t-shirt business is an event-driven business. Every shirt had to touch 22 hands before it left the building, and every order is custom. So it's an extremely difficult business to do well. And I really grew tired of the details of the day-to-day of that business. And so started buying content. Content was like the super contrast to doing custom t-shirts. Instead of 22 hands touching every shirt, content was like, hey, you produce content here and then you have some ads on the page. You never know who the customer is. You get lots and lots of visits and they're much more shallow. So I became pretty enamored with that and went on a buying spree, and spent about 6 years buying and operating, and was approached by a private equity firm in 2015 and ended up selling my portfolio in a roll-up that they were working on. And so I kind of found myself without something to do. So I started kind of tinkering, acquiring things here and there. And that's when I met Mark Doust at Quiet Light. And so Mark, it wasn't as easy to convince people to come on to Quiet Light in 2016 as it is in 2022. But he kind of said, like, look, this is like the ultimate lifestyle play. And if you're tired of operating, I really think that you could do well at this. And so he kind of subtly over a 6-month period kind of lulled me in. And I actually have not regretted it. I really enjoy kind of getting in and getting to know people's businesses and getting to help them. Entrepreneurs like transactional relationships, and what can be more transactional than doing transactions? So I've kind of enjoyed that piece of it. And it's also got the emotional kind of roller coaster of being in the deal. So it's not always easy to do the job that we do, but I do think that one of the things that's great about Quiet Light is you've got 15 people that just have a lot of different experience. And so I feel like we really are able to lean on that experience and help people get through it in a way that's really helpful to them. And so I think what we do has real meaning. And then in terms of aggregators, it's great to be on this with Chris because he was like inside. So my introduction to them was a little bit different. I remember Joe sent an email and said, hey, meet these two guys from this big prominent aggregator, and I was calling them PE-backed operational companies, and I thought I was going to like coin the phrase, but I lost. Aggregator won within no time, and I was like,
Aggregator okay, rolls off the tongue a little easier.
Yeah, I know. I was like, hey, I had this call with these guys that are PE-backed operational companies, and people were like, okay, we're going to call them aggregators. So anyway, that was a real change because when they came on the scene, the first deal I did, I was like, whoa, this is weird to work with people where like the money's there and they know what they want to buy and they like can put a term sheet out quickly and close quickly. So I jumped in like 2 feet, as much as I could right off the bat and closed a bunch of deals early on. And so I got a lot of experience, just kind of, it was really just circumstances where things kind of aligned for me. So I ended up doing a bunch of deals with aggregators that gave me some experience in that space.
That's awesome. I think there's so much experience between the two of you to be able to speak to this topic today. So this is awesome. For anyone who joined a little bit late, there's a Q&A chat box at the bottom of the Zoom. So if you have any questions throughout the hour, just plop them into there and we will get to them. So you kind of started to talk about it a little bit, but I'd love to talk about the evolution of the aggregator market. Obviously, there was a time we didn't have aggregators. They blew up. Now it seems to be this big buzzword that a lot of people like to use. And obviously they play an important role in the industry. So Chris, I guess you were there from the ground up in terms of some of the first aggregators on the scene. Can you just give us a little bit of the evolution of the aggregator and how we'll get to a little bit about where it stands today, but just sort of how we got to where we are.
Sure. Yeah. So, the concept of roll-ups have been around for quite some time. And I think what became attractive, certainly in the early days and how we were pitching, one-on-one commerce is like, look, you can buy these assets at a very low multiple compared to what you were seeing kind of PE firms buy other e-commerce businesses or larger commerce-based businesses, inclusive of retailers. And that attracted kind of initially some interest from venture capitalists. And that's how one-on-one commerce got started, is we raised, a traditional round that you would raise from venture capitalists with the goal of going to acquire these things, roll them up, have operational efficiencies and then create, a portfolio of these that represent a significant amount of e-commerce revenue that then you could either sell or take public. And it was it was really attractive to venture capitalists at the time because the concepts of roll-ups had, again, existed for quite a while. So in the early days, I think if I think about one-on-one commerce and as Thrasio came on, there was less of a focus on the category that you were buying in, more so just buying things, right? And so a lot of the aggregators at the beginning were graded on their ability to acquire businesses, which was great for sellers and great for Quiet Light. And because a lot of the first employees that these aggregators had M&A experience and banking experience, the transactions went relatively smoothly. And as Brad said, the money was there. They knew how to do transactions. They had all the legal agreements in place. And so, from kind of LOI to the money getting into escrow went pretty well. I think where things got a little caught up is then the theory around being able to have operational scale started to fall apart a little bit. I think as aggregators got into it, realizing that, if you're running one Amazon business that's, based on FBA, if you're running another Amazon business in a different category, there's actually not a lot of efficiencies that you can create there. They generally have different factories, different supply chains, different marketing tactics, different customers, right? And so it really did look like you were running two separate businesses where the goal was to, ultimately merge these together and get operational efficiencies. And I think we'll kind of get into some of the challenges that aggregators that have. I should say up front that, look, not the headlines are pretty rough on aggregators right now, but that's just headlines, right? That's not the full truth here. There is a whole lot of aggregators that have raised a lot of money, many of which are still buying, still operating, and doing a great job. There are some that got a little ahead of their skis. And I think what the big change in the aggregator market that happened was, when I was at one-on-one commerce, we were trying to convince banks and bankers to give us debt facilities to go just for working capital on these businesses. And at that time, this was early 2018, they didn't understand what we were doing and weren't willing to lend against us at all, even for working capital. That changed going into kind of late 2019, 2020, where you started seeing these enormous debt facilities that were given out to aggregators. And to give you a sense on what happened there, I mean, from 2018 to 2020, there was about $1 billion worth of money that was put into the market for aggregators to go buy businesses. That's a combination of equity and debt there. From 2020, I think, to 2021, so kind of going into 2021, there was another 13 billion that was added to that. So we just saw this massive acceleration of both aggregators coming on the scene and a huge amount of money. And that money was being used not for working capital, but also to acquire companies as a vehicle to acquire companies, which kind of set off this frenzy in terms of a supply and demand imbalance there, to where there was kind of more buyers there, so the market was paying more, and we saw kind of multiples on deals go up. And so that was good for the market. Now, what ultimately happened is a lot of that debt was spent, right? And with that debt comes rules from the bankers called covenants around what these aggregators have to do to maintain their ability to pull from those debt lines. And I think what happened is a lot of these aggregators got in default as rising supply chain costs started happening, as operations became challenging. It was difficult for these aggregators to find talented people who weren't already doing this themselves to actually pull them in and do it for them. Because as we know, and I'm sure many people on this call that are listening that are operators, if you're really good at running an Amazon business or an e-commerce business, then you're probably doing it yourself, right? Why go work for someone else to do that? There might be reasons to do it, but I think most people kind of do it themselves. And so, as a result, I think businesses that were acquired, they weren't, the narrative wasn't playing out as kind of planned. So, the aggregators were talking about growing these businesses, and the debt and equity providers to that were really excited about that. When that didn't happen, then their ability to buy kind of went down. They had to focus in on operations. And by that time, I think for some, some of the assets that they had bought had, started declining. And as we all know, it can be difficult to right the ship when that's happened. So that's a little bit of the history. I kind of pass it on to Brad to add a little bit from his perspective, because I know he was more on the representing sellers during that time to where I was on the operating and buying businesses.
Yeah. I mean, just a couple things there. I thought that was a pretty good summary of kind of where we are. But, one thing that I kind of picked up on pretty quickly, I did several deals with Thras early on. They were definitely kind of the first mover to really get a lot of traction in doing it. I think Chris hit it on the head when he said they were good at buying businesses. Like, categorically, nobody really cared early on. There really was not a whole lot of talk like, we want to be in this category and not in that category. When we start to talk about where we are today, that's a big factor. Like, they're realizing like, hey, we can't run everything here. We gotta focus on something. We have to specialize in something. But I do think that, like, I would talk to sellers, and is a little disheartening on the broker side to kind of see the evolution of it, because early on, we were seeing, hey, we're always trying to give like a very beneficial outcome to our sellers. That's always the plan. Like, we want to give them the easiest deal they can get for the most money. And so we see this new opportunity, and there wasn't a lot of news about them. And so we're seeing opportunities to place them with these aggregators, and people are competing, and it's going faster than the expectations that we've set for these sellers in terms of the process. And they're closing at a higher percentage rate. Even today, like, I've done 15 aggregator deals in my time at Quiet Light. I've only had one breakdown until actually I had one breakdown this past week. So that's two. But I was batting 1,000 for a long time. And like, I was even using, I was like, hey, I don't know, but like, I'm batting 1,000 on these. So they're like, it's really not normal. And so I would say to people like, look, we are in the honeymoon phase. I don't know what's going to happen with this, but the honeymoon will end at some point. And I really think that one of the big macro things that really affect the debt facilities, which I think the debt is a massive factor that Chris kind of hit on, is, our country and the world has really been at 0% basically Fed funds rate for about 20 years. We have lived on cheap debt, and we are seeing carnage across all sorts of industries in the last year, because due to whatever it was, after effects of COVID and the increase in money supply, they've decided, hey, we've got to fight inflation. And so they want to raise the Fed funds rate, which raises the rates for many people on their debt. And so that affects the US government. That affects every, American or anyone all around the world. I mean, the US dollar actually has a lot of control over all the world's currency. And so I think we've really seen that, like, the higher risk things have deflated quickly. And so one of the areas in our little corner of the world is that the carnage came quick with the aggregators, because there was like a quick realization of like, hey, we took out debt because debt's cheap, but all of a sudden debt's not going to be cheap anymore. And also we're seeing troubling trends in the supply chain, like Chris already mentioned. And on top of that, these are not as easy to run as we thought. We sold everybody on this idea. They're like, hey, I mean, if you know how to run one Amazon business, you know how to run them all. Well, that proved to be false. These are real businesses. Amazon businesses are a little bit of business light. Like, if you come from the custom t-shirt world where you had a factory, you start thinking like, man, an Amazon business seems like a breath of fresh air. But when you start dealing with an Amazon business that's selling in different Amazon marketplaces around the globe, and that's managing multinational supply chains and 3PLs, and is dealing with patent issues and trademark issues and things like that, you start to see that these businesses are much more difficult to run well. And it's hard to just put like, hey, let's put Johnny employee over here to oversee these 5 stores and be like, here, you're going to manage the day-to-day on these. There's more to it than that. And so I that's the only thing I would add is just, I really feel like the stage was kind of set for a bubble, and that's how markets always react. Like, if some element of business gets too easy, then bubbles are created, and those bubbles don't pop until we take them a little too far. So I think that Chris is right, that there were some folks that got a little ahead of their skis that created higher multiples in the market. And whenever things started to not look as perfect economically, it really put some pressure on quick.
Sure. So, I mean, both of you sort of spoke a little bit about this bubble and the honeymoon phase. And so, in terms of 2022 today, um, Brad, how would you characterize aggregators? Like, are we out of that honeymoon phase? Is it a complete, it's just that now they're more category focused? Or how, if you were to describe an aggregator to sellers today, like, what would you say?
Well, it doesn't feel like the .com bust to me, at least not yet. So I would say we've definitely come down. I'm seeing much more of what I've come to expect in deals over the last 5 years. I always found the job as an advisor to be a challenging job. I think that this period of time where we could take a business to an aggregator and they would scoop it up and buy it, and it seemed like a relatively easy deal to get done, was not the norm from what I had experienced. I experienced more of a world where it's like, hey, selling a business is tough. Businesses are delicate. They fall apart easily. The trends can change fast. The buyer can flake out. The seller can flake out. There's all these different factors. And so, there's a reason why they came up with the phrase time kills all deals, because these deals are very delicate. So when I look at it, I would say the same thing. Like, here's what I see. Like I'm on Twitter and I kind of see what's going on in the world. I mean, if I spend too much time on Twitter, then I become convinced that like World War III is going to start tomorrow. And so
Right.
That's how people act when you're at the bottom, but that's also how people act when World War III is getting ready to start. So I don't think we know exactly, where we're at in terms of the world and the macro outlook and that kind of thing. But I do see discretion again. And I do see categorically that there's concern. I do see people being much faster to be like, that's not a fit for us. But I also see some evidence of carnage. Like I had a deal fall apart for literally no reason. Had an aggregator, put it under LOI. The global situation has not changed much in the last 3 weeks. And they literally got on the phone and said, hey, we're backing out. And I was like, oh, you're backing out. Okay, well, what's wrong? Did the business not perform? No, the business looks perfect. Oh, okay, what's going on? We just don't feel good about the world.
Wow.
Okay. Are you still buying? Yeah, we're still going to shop around, but we might change our criteria a little bit. So that's frustrating to see that, but I do think that's indicative of where we are. Like there's some fear in the market. We're starting to see that there's more and more fear present. I've been pleasantly surprised at how well we've still been able to manage deals and get deals done. If you look at our website right now, you can see that many, many deals are under LOI heading on their way to closing. So I think that transactions are still going, but I do think there's a much more caution in the air.
Sure. And Chris,
and I'll just kind of add to that a little bit. So I'm not on Twitter, so I don't speculate about the world because I don't know what's going on with the world since I'm not on Twitter.
It's not useful for you anyway, Chris.
Yeah, I mean, I think what I'm seeing, maybe the way that I interpret it is that, as Brad mentioned, a lot of the aggregator deals, say in the 2020s, 2021s, like they felt easy, and to put a little bit more definition on that, it seemed like maybe the full amount of kind of, initial investigation and diligence that a normal buyer would do up front wasn't there, and that a level of detail even during diligence wasn't there, and so things just really coasted in the fact that aggregators generally did what they said they were going to do, which is, hey, we really like this business, we understand it, and we want to buy it, and they did that. What I'm seeing now is, aggregators starting to not starting, they are becoming more like all of our other buyers. So if you kind of look across all the other buyers that we have, a lot are like individuals or small portfolio companies. And when you find them, they're heavily invested and heavily incentivized to make sure that they're, dotting all the I's and crossing all the T's, both, in the initial buyer seller calls, like reviewing the materials that we put out, and also during diligence. And you could really see that prominently displayed on buyer seller calls. If you get an individual that's looking to buy a business, that's an individual buyer, they are asking very detailed questions. They reviewed every little piece of the business summary that we do. Sometimes we were seeing aggregators just kind of ask very high level general questions and frankly selling themselves to be the right person to acquire the business. Now we're starting to see that kind of come together a bit more, to where the aggregators that I've been talking to and selling to over the last year, they're asking all the detailed questions that a regular buyer would be asking. asking there. And so I think there's just the ones that are out there still buying, by which there are many, are just becoming far more focused, as Brad mentioned, on whatever their thesis is, generally on, you know, a category or a specific type of thing that they are buying, and they're becoming, you know, far more focused on the business itself and learning about it before they make a decision.
That's interesting. And I want to come to this and come back to this in a second, because we have a question that I want to get to first. But as a reminder for a second, it'll be about the buyer pool that you just mentioned. But because we got a viewer question, I just want to make sure we answer that in real time. Thank you for the question. It is, you've mentioned multiples a couple times. Are aggregator multiples better, worse, the same? So kind of a loaded question. Thank you for that. Brad, I don't know if you want to take this one to start.
I will say that when I first started doing aggregator deals, they were definitely lower multiples. So that would be, I sold a couple that were in kind of the mid twos early on. That would be considered pretty low today. The aggregators were kind of selling people on, it'll be all cash at close. We'll get it done quickly. We can do a quick round of diligence. Some of the things that Chris just mentioned, you know, that were kind of present. And so it started out like that. Very quickly, the multiples started to exceed what I would expect on other businesses. I would have people reach out and say, do you have any businesses that are available that are just Amazon? I don't want any diversification into other channels. And I'm listening to that and going, it's so weird to hear someone say, I don't want diversification. Like, it used to be that we sold businesses for premiums when there was diversification, that was like something they wanted. And we definitely entered this phase pretty quickly where people didn't want diversification. So my kind of assessment of the multiples was that they started under, and then about a year in, they were a little bit over. And then when things started to really get hot, they got way over. And that now we've kind of come back down to where they're still trading at really good multiples, because I do think the operational efficiencies are there. I think that there actually is some value to this idea of like, it didn't pan out the way they wanted it to. Like, it's not like, oh, hey, these are super easy, I can just put a low level person on this. It didn't turn out like that, but it is easier than having to manage all your own technology infrastructure on your platform and all these different things. Like, it really is more of a, we're selling products here, and we have this, you know, one interface that's available to us that happens to hit an overwhelming majority of consumers in one way or another. And so I think that ended up being, you know, a big benefit to where people are still, even today, willing to pay on par or maybe even above the multiples that you would have expected for a single channel, you know, type of business. So I do think that as we look at it today, I believe that multiples peaked in 2021. It feels to me like around somewhere in the spring to summer of 2021 that things got really frothy. It almost was as if there was nothing available. Things were trading at really high multiples. I started getting emails from people asking me if I could sell their business for multiples that like I would never throw out in like a general call. You know, like, hey, I'm getting people directly telling me they can get me whatever 7, 8x for these businesses. Well, I mean, I've got an 8x, you know, business that's supposed to go under LOI next week, but that's a really rare thing for me. That's a really large deal, and it's a super unique situation. I mean, that's not something that I can usually just deliver for people. And so I think that the multiples have dialed back a bit. I don't think that we're at like fire sale territory or anything like that. I'll just give some anecdotal. I've had a couple of aggregator deals in the last couple of months, and I'm seeing that stuff trade in that normal kind of 3.5 to 4.5 range. That seems to be a pretty accessible range for a lot of people on the buying and selling side. And so I feel like that's, you know, 3.5 to 4.5. And then a lot of those deals, those are all plus inventory. So the actual all-in multiple is a little bit higher. So that still feels really healthy to me in this space from what I've experienced.
And just
I'll kind of add on. I'll just add on to that real quick, which is that you know, I think we shouldn't be talking about aggregators as we're talking about multiples. Aggregators are a part of the marketplace, right? And so kind of multiples in general, it's like, are aggregators paying more or less? As Brad mentioned, like, not just aggregators, everyone was paying structuring deals to be a little bit more total consideration,
True.
probably in the peak of 2021. And what we're seeing from aggregators is that there are just less of them bidding on businesses than there were in 2021. And so as a result of kind of less demand from the aggregators, they are less willing to go up, because as a seller, you have kind of less leverage as you have, less number of offers. With that said, I think most of our deals are still seeing multiple offers. Aggregators are often involved in the mix of those. They are one of, many segments of buyers. And yeah, I think, we have to hold ourselves accountable. We can't get off this call without, putting actual numbers out there. But, Brad mentioned kind of 3.5 to 4.5. I'm also seeing kind of, it always depends on the business, right? And where the business is at. I've had, recently kind of a newer business that had only been around for 2 years, but it was a solid, only US based FBA business that, was kind of in the 2.6 realm, cash at close plus a stability payment that got them up to kind of 3.25. And that is, that kind of structure, and we should probably get into kind of structure of deals, which I'm sure we will, is kind of something that we're seeing. And I kind of personally view that as a very, as healthy, particularly for if you kind of look at the attributes of that business. But I think we should always, give the disclaimer up front that it is very difficult to get blended multiples because of the kind of statistical variances and the differences in the type of the business. I think the most important thing to say is that businesses are selling, aggregators are involved in bidding on these businesses, and there are multiple offers on most businesses at the moment.
That's great. And thank you so much for that question. For anyone else tuned in, if you have any questions throughout the next 30 or 20 minutes or so, feel free to put them in that Q&A chat box and we will get to them. So you've talked a little about the buyer pool. Obviously, there's more than just aggregators. A lot of things we hear from some sellers or people who come to us looking just for information is like, is the aggregator the only option? Is it the best option? And so I know we've talked a little about this. I don't want to beat a dead horse, but it sounds like, no, it is not the only option. It could be the best. It could not be. It just sort of depends. Obviously, there's a whole variety of types of buyers you could buy from or sell to. Do you guys have any thoughts on the buyer pool beyond what we've already discussed already? Just before we transition to a different topic. And Chris, I can start with you this time.
Yeah, sure. I think, so, what I've seen kind of over the last year is, well, one is SBA buyers, which has been kind of an interesting increase over the last year. So I think I'm making some assumptions here, but I believe that SBA buyers really missed out kind of 2020, 2021, because the all cash at close from aggregators and kind of portfolio companies were very attractive to sellers. And so it was difficult for kind of an SBA buyer to win, because for those of you who don't know, oftentimes there's a little bit more work involved, a little bit more risk, because there's kind of third-party players like the government and underwriting banks, and it generally takes a little bit longer to close SBA deals. So, for sellers, if you have kind of what you want to get cash at close kind of as an offer comparable to an SBA deal, you're always going to take generally the cash at close. But recently we've seen, a lot of highly qualified SBA buyers that, have put in great offers on deals. Those are generally all cash at close because of how the deal dynamics work. So there's definitely been an increase of that this year in the buyer pool. I think something we don't often talk about at Quiet Light, or you don't really hear talked about, is the concept of what I would call portfolio companies, which they look a little bit like aggregators, but they're very, category specific. And I kind of say they hold less than, 15 brands, often less than 10 brands. Those buyers have been focusing on operating over the last couple of years. A lot of portfolio companies have been around for a very long time. In this world, that means, 5 years or longer. A lot of them started some of the own businesses that are in their portfolio. And certainly we've seen kind of those buyers interested in looking around. I'd say the third, and then I'll hand it over to Brad to kind of get his take, is that, look, with the market being down a little bit and, cash being a little harder to come by because of increasing rates and debt, people that have cash, AKA value investors, like they're coming back too, which means like they're looking to find deals. That doesn't mean they're looking for distressed assets, but they want to see kind of value for the fact that they have they have cash to spend right now. And we're starting to see a little bit of that. That means that, multiples might be down a little bit, but there could be some interesting structure to those deals. And they're great buyers to work with as well.
Yeah, I would agree. Specific on the SBA, I think you're exactly right, Chris. I think that SBA buyers did miss a big chunk of 2020 and 2021. And, those SBA buyers fit into a very specific window for the most part. I mean, you can only finance up to so much of the business. I don't know what the current number is, 5 million or something like that. And so, those buyers, those deals take a little longer. And those third-party factors are a big factor. One of the things that's interesting about SBA is I find those deals, I always advise my sellers, I'm like, look, as soon as we sign an SBA deal, I'm going to have less power than I normally have in these deals. And so I'm not going to be able to make things happen as much as I might be able to. There's so many other factors involved. But an interesting thing about SBA deals is they close at a really high rate. It's just the process from getting to LOI to close is usually a little bit more bumpy. It feels like the deal might fall apart sometimes once or twice during that phase. And I've tried to prepare all my sellers that are going to go SBA for that. Like, hey, this is it's a little bit of a ride, but I've had a really good success rate at, getting to the end of it. It's just, you kind of got to be prepared for the emotional ups and downs of it, because just the way that the banks and the SBA and these different things can seem a little bit impersonal. Sometimes you think they're pulling out of a deal or they want to change some term that you already agreed on. Those are really hard things to explain to sellers and have them feel good about. So you got to try to prepare them on the front end. But also the cash, I think, is a huge factor. I think one of the things that I'm fighting against right now, and I feel like I'm having to fight less and less against it, is earlier in the year, I was having to explain to people that things aren't good. Like, I was having to let people know, like, hey, the macro situation is not great. We're getting a lot of news about things that are happening to aggregators, about things that are happening to other higher risk kind of investment type facilities. And so getting people on board with that. One of the things I've noticed in the last month is when I do valuation calls, people seem to be more aware that the economy is not in its greatest spot that it's been in the last few years. So with them acknowledging that, I don't have to tell them how important cash can be, and that if we find a cash buyer, that a cash buyer really should get the most deference because it's the sure thing. It's much more, we're not, these stability payments, we've had aggregators where we've had good luck with stability payments. We've had stability payments that have not gone well. So we've seen a mix, and that you can even find news articles that have been written about these stability payments. There's even lawsuits about them.
Or follow Brad on Twitter.
So I do think that, like, the cash cannot really be understated. And so when I get on valuation calls now, I tell people, hey, don't know exactly where the world economy is. There seems to be a bit of caution in the air. Want you to know that if someone was willing to pay cash for your business, I would be inclined to advise you to take that deal if it was a fair and reasonable deal, even if it was less than another type of buyer, because when uncertainty is around, that cash it has a higher weight in my book. And so I've been trying to let people know that.
Right. Makes total sense. It's been a crazy past couple of years, obviously, for our industry and every industry. I want to go back to deal structures in terms of a lot of questions we get are like, do these differ from if you're doing a deal with an aggregator versus an individual buyer? How do the structures come together, the negotiation, et cetera? So Chris, do you want to kick this one off in terms of deal structures with aggregators? Are they the same, different? I'll let you take it from here. There's tons we can cover.
Yeah, it's changed over time, but let's just focus on where we're at now, because I think that's probably what people are interested in. I think the shift that we've seen is certainly aggregators looking for more financing structure from the sellers, whereas they used to do more cash at close. They basically coined a new term called the stability payment, which we internally at Quiet call an earnout, because it's not guaranteed that you as a seller are going to get that. The way that it first started was, they would say, look, like, here's what we're looking for is stability. As an aggregator, we're buying your business. We're paying a good multiple for it, giving you a good amount of cash up front. for that business. And we just want, you to warrant and rep essentially that like this business is going to do as good next year, the next 12 months as it did the previous 12 months. And as sellers, and honestly, as brokers ourselves, we were looking at these aggregators that looked super sophisticated, and they were talking about how they were going to be able to operate. We kind of took them at their word, at their ability to do that. And so the stability payment was framed as, if you do that, then you will get additional more money, generally in the form of an additional multiple on the business or more than that. And what we found is that some of the aggregators weren't really good at operating, therefore the sellers didn't get that. And so what I personally do right now is we're moving more towards, if there is a stability payment, I think it's important to think about what that stability payment is tied to, whether it's revenue, gross profit, contribution margin, or net profit. Particularly as a seller, you have to think about how much control do you really have over that over the next year? Are you going to be involved in the business? Is it clear what your involvement is going to be in the business? And the less involvement you have, the more you need to kind of move that up the P&L to what that's attached to. So if you have no involvement in the business and you're taking on a stability payment, that probably needs to be tied to revenue or gross profit, because you really don't have control over the operating expenses they're going to have for the business. I'd say the second thing that we're starting to see is it used to be all or nothing. Either the stability payment was earned or it wasn't, based on, that metric being in the trailing 12 months. Now we're looking at tiered stability payments where you can still get 70% of the stability payment if your business is operating at 70 to 80% year over year. And I think that's been great for both the sellers and the buyers in terms of structure. Look, there's been a lot of kind of uncertainty and turmoil over the last year, and there's more kind of in the future. So, I think kind of pinning that to an all or nothing stability payment isn't great. We're also, I think, seeing a bit more earnouts tied to it as well. So a desire from aggregators to keep the sellers more engaged over a period of time to help kind of navigate the ship and be available for calls. And those earnouts are looking a bit more realistic than maybe what they were, a year ago, in terms of like actual money that could be on the horizon for the sellers. And then I think to the final answer of like, does this look like other deals from our other buyers? I would say kind of. That's why I think SBA's deals are starting to win out a bit more, is because they are predominantly cash at close. And so those deals are now looking more attractive to this makeup of what we're seeing from aggregators, which is cash at close plus stability plus earnout.
Yeah, and Brad, you've mentioned a couple aggregator deals on your side. Would you say, is there any other structure commentary you would add to that?
Not really. You used to see a lot of performance incentives, and those are gone. It seems like I really feel like stability has kind of won the day with the aggregators. And I've seen a lot of like 2/3 of what we're going to pay, we'll pay in cash. And then the 1/3 is the question mark. That puts the deal generally down in the kind of multiple that they're looking to pay, I think, and then kind of protects them on the back end from it. I've had a lot of people reach out to me and say they read Joe Valley's book, who's one of the owners of Quiet Light, and that has actually had some sellers tell me, hey, I want to make sure the earnout is based on revenue. And I have not had good luck getting that done. I've tried to propose it, but it seems that in the situation that I've had, the aggregators have been unwilling to base it on revenue. They've wanted to base it on some agreed metric of SDE usually. And so I do think there's still risk, because, when you're using SDE, there are ways to manipulate the data there. And so I think that it's just a risk our sellers have got to kind of take into account and try to see like, what do you know about these folks? I really prefer to do deals with companies that I've done a deal with before. But I can't always do that, or else I'll lose my buyer pool over time. So it's tough to kind of know, do you go with the known commodities or do you try someone new? Me and a seller just had a deal break down, and we actually got it back under LOI before we got on this call today. And we took our chances on a new commodity. They looked the part, they were really reasonable to work with, but at the end of the day, that's one of the reasons why I like to go with known commodities, because, I'm having to get on the call with my seller and let them know that a deal had broken down and we're having to try to pick up the pieces. It's very detrimental. It's not possible there'd be anyone that's any more harsh to people who break deals at Quiet Light than I do, because I get so mad about it, because it is so detrimental to what we're trying to do. It's, we really need to manage these deals and get them done with the buyers that we choose. And no one can afford to have the deal break down. It's just so detrimental. And I think these aggregators that have been short-sighted and buyers that have been short-sighted, thinking they can walk away from a deal and there's no consequences, are not thinking long-term about what this is going to do to their reputation. I mean, as soon as we start noting up in our system, this person broke a deal. Like when I see this person broke a deal, I'm like, hey, we're probably not going to want to work with this person. It's just not a good long-term view. So I do feel like the structure, he pretty much hit it on the head. But I do think that there's also the factor of like, I'm trying to go with people that look experienced. I'm really being careful about taking a chance on the new aggregator right now. It's just, I don't want to be the guinea pig. Let somebody else do that. And then we'll try to do it. And if we are going to do it, I'm going to be in my seller's ear, letting them know like, hey, I really don't know. Like, I've done all the research I can here, but we're taking a chance.
Well, I think this is actually a really good segue to a question or maybe a misconception, I should say, that if you are going to sell to an aggregator, you don't need a broker. You can just go straight there and that's it. So maybe you guys can speak, and Brad, I'll start with you, like a little bit to why work with a broker? Like, what are the pros and maybe cons of using a broker when going through an aggregator to sell your business?
Yeah, so I don't take a hard line on this. I know that some folks at Quiet Light do. So I'm really not here to convince people that I can provide value that I may or may not be able to add to a deal. If you have a direct outreach from an aggregator and you feel comfortable with them and you think that they're giving you something close enough to what the market is providing, we charge fees. You might be able to save on our fees and do the deal. I would say that here's where we can potentially help you, and maybe just something for you to consider. Number one, we do have a lot of information about a lot of aggregators. I think we've got 80 that are pretty detailed in our system. That's a pretty big number of, these are folks that have come, they've filled out information on our side. They've done interviews with our buy side team to kind of understand what they're looking for, what's a good deal for them, all that kind of stuff. So we've got good information, and then we can learn about what they've closed, what they've done with us, what they've done with others. And so we can have pretty good information about them. But I would say that like the value of what we bring is, I feel like we can keep people honest. So, you can get someone to reach out to you and give you a direct deal. And then you might have a couple of other contacts available to you of other people that have reached out, and you can run your own process. Where we can step in is we can tell you, hey, we can make sure that everyone gets a chance to look at it. That's one thing. We've got good information, good contacts for these different companies. And the other thing we can do is when they start giving you legal terms, we can tell you if this is what we've seen in other deals. We've done a lot of deals. We've done a lot of deals with aggregators, and we've done 850 deals in total. So we have just a lot of data at our fingertips about what is normal and what can be expected. And I have seen that in some of these situations where people go direct to sellers of ours, they do try to take advantage of them. So I would say that for any seller, they just need to weigh the difference. Like, I'm not here to beat the table and say every single person needs an advisor. I don't think that's the case. I think that if you're a sophisticated business person that understands the market, you could run your own process and try to do it. But I think that in many cases, going with someone like Quiet Light, where we have a lot of data and we're not slick in the way that we operate. We try to be super transparent with everybody. Like no one that works at Quiet Light on the advisory side is a person that's living paycheck to paycheck. These are people that have been proven entrepreneurs. This is a lifestyle choice that these entrepreneurs have made to be on this team. And so they can give you good advice about how to handle different situations. So I really just think it's case by case. Obviously we'd love to work with anyone that thinks we provide value, but the last thing I'd want is for someone to pay me fees and think that I did nothing to earn it.
Yeah, I think I agree with everything you said, Brad. I would add one thing, which is I'm just a believer that kind of marketplaces are efficient. And you'll never really know the full value of the business until you bring it out to the market and you have multiple people looking at it. We have a pretty large list of buyers that are actively engaged, and then you'll know really quickly whether what the aggregator is offering is what the market, it truly values your company at. So I kind of always kind of take that into consideration as you're thinking about going direct. I'll say this too, in private conversations with kind of M&A people at aggregators. I mean, look, I was one as well. I was doing M&A at an aggregator, and I personally, and some of the people that I've talked to, they enjoy working with Quiet Light and other brokers on deals because everything's buttoned up on the seller and they know exactly what they're getting. Therefore, the transactions are much smoother. Generally, what we hear privately from aggregators that don't like working with us is because they feel like they have to pay more for companies that are going through us. So, as a seller, you should kind of think about that.
That's great. Well, we're just about out of time. Thank you both so much. And for everyone who tuned in, if you want to let people know where they can reach out to you, if they have other questions or follow-ups from this, Chris?
Yep, you can just find me at my Quiet Light email, chris.duty@quietlight.com.
And Brad?
Brad@quietlight.com.
Nice and easy. And we'll be sending out the recording of this in the next day or two, so you'll be able to rewatch it. And if you have questions, of course, you can follow up. Again, you can catch us in November and December for webinars, and every Tuesday for our podcast, YouTube channel, for more content like this. We hope you enjoyed it, and we'll see you next time. Thanks, everyone.